Well, good afternoon. Welcome to a later in the morning version of Rick Helps Real Estate Show. I didn't do it this morning at 8:30. Had to help a friend get a ride for a medical procedure this morning. Had to get up at 4:30. Let me tell you. Yeah, I took a little nap when I got home. But anyway, I saw some news today that I thought I'd share with you. First of all, on our listings, we have 5,120 today. That's a drop of about 200 from yesterday. 7-day moving average shows 4217. Came on the market with 3,813 under contract. So it looks like this when I show you on the listings versus contract. Once again, this is the blue wave. This is listings that are coming on, and these are contracts. And I like the way that is looking now. I like hope that is a trend. So what we're seeing is an increase in listings. People are starting to see that they can get more for their house now. They're more comfortable having people come in post COVID, and so it's making a difference. But I wanted to explain one more time this Crawford market index for everybody. I'll get my head out of there. The Crawford index is a mathematical calculation. It's an index. It's not number of listings, but it's an index looking at the number of listings available, the velocity of how listings come up, and then how many homes are going under contract and how quickly, and they come up with this index. We peaked at 514 here in March. So when you see this line coming down, like I said, I want to put it in perspective. When it hit 350 down here, we were all shaking our heads and saying, man, this is the most brisk market I've ever seen. When it got down to 350. And right now, we're at 430. So what I'm saying is at 350, it was a massive, massive seller's market, and we were all just stunned. I was like, man, how much more of a seller's market can this be? And we saw it went all the way up to 514 in March. And it's still aggressive. Just because we're seeing a chart coming down on an index does not mean that it's slowing down out there enough to where you can notice it at all. You list your home, you will still get multiple offers. And let me send a quick message here. It says I got to call somebody back. You'll still see multiple offers. So that part is not going away. The drop in contracts is a bit of buyer fatigue, and it's a bit of summer vacation. But it seems to be happening nationally. So you can't really apply any seasonality to it just for the Phoenix area. So the Crawford Index is validating what we've seen. The other thing that we're seeing right now today is that the Federal Reserve is holding steady on their rates, but they raise their inflation expectations. Even that's kind of muddy news. The Fed governors all get together and they do these dots. They put down where they think inflation's going to be. So collectively, it averaged out to where they think inflation's going to be at about 3.3%, I think is what it is. The Fed raised its headline inflation expectation to 3.4, a full percentage point higher than the March projection. So that indicated that they think they may see some hikes in 2023, where before they said they weren't even thinking about raising rates. So they are thinking about thinking now. So that's the news. And what kind of difference did that make? Jamie Dimon says JP Morgan is hoarding cash because there's a very good chance inflation is here to stay. They're hoarding cash so that they can buy treasuries at a higher rate. So that's an interesting development there. So he has jumped on and said he doesn't believe that inflation is temporary. Now, there are many economists that feel that the inflation numbers that we're seeing right now are just an aberration because of supply side issues and not every company's back to work. We still have a labor shortage. People are making more money sitting home than they are working. And so they think this is just going to go away. So in the meantime, a lot of things moving around in the financial markets. But what does that mean to us? Well, the markets reacted a little bit today when this came out, when these notes came out that the Fed is looking at raising their inflation expectations. The market had been kind of avoiding that, thinking, well, maybe it is transitory. Maybe inflation isn't staying here. But now that the Fed's starting to kind of take a second look at it, the market's reacted. The stock market went down. Bond markets made a move. Not a big move. If you look at the rates, right today it shows a rate of 3.18, whereas on the 10th it was 3.08. Yesterday it was 3.12. So it went up plus 0.06% today. So not a major move. I mean, it might be, might turn around, come back down tomorrow, but that's not my area of expertise. So here's an interesting article. Instant reaction, housing starts June 16th. This is from the chief economist at, I think it's not National Association of Realtors, I believe. And he's saying that housing starts picked up in May. And they're saying that the tilt is a proper response. Oh, what they're saying here is that they're building more single-family home building and subdued multifamily construction. I would agree with that. So he said this tilt is a proper response given the limited single-family home inventory and what had been deacceleration in apartment rent growth. There are apartments everywhere. Despite the month-to-month trend or even year-to-year changes, America is facing a massive housing shortage due to multiple years of underproduction in relation to population growth. We estimate around, 5.5 to 6.8 million additional housing units need to be built. That's a big number. America is on track for only 1.6 and 1.7 million new housing units this year and next year, respectively. That would represent the best 2-year performance in 15 years, but it still would be inadequate. Therefore, expect both rent and home prices to outpace overall consumer inflation in the coming years. He doesn't say next year, he just says in the coming years. We have a comment here that says, I'm living in a studio paying $1,000 a month rent. Is it good to buy a house right now or wait for a year, although prices are high? Don't worry about the prices. What's your payment going to be? Find out what you can afford and find out what your payment is. Interest rates are 3%. You're starting to see indications now that rates are going to go up. Is that going to lower the payment next year? So if prices go up this year, which they are, and they will, because all indications are inventory's coming down slowly, but you're paying 0.5 to 0.75% more in interest next year, and the house is higher priced next year, how does that compare to your $1,000 a month studio rent? And again, it depends on what part of the country that you're in too, and whether or not you can afford it. So that's kind of an individual question where you actually need to meet with a lender and say, hey, tell me what I can afford. What kind of a down payment do I need? And then compare it to how much you're paying for rent. Because right now what people found out, the people that were waiting for the crash, have seen a 30% increase in the price of homes this year alone, and a 17% increase in rent. You got burned on both sides. Your rent went up while you were waiting, and you didn't build any equity and get any of that 30%. Now, can things go sideways? We never know. In fact, it's interesting. There's an article out there now, and I always look at the headlines, and then you read the details. And the headline here says, World's Bubbliest Housing Markets Flash 2008 Style Warnings. This is by Bloomberg. So you get in there and they start talking about New Zealand, Canada, Sweden rank as the world's frothiest housing markets. The UK and US are also near the top of the risk ratings. So that kind of gives you a red flag, right? They're going, ooh, risk, this is awful. And they're saying that there was a cocktail of ingredients. But I scroll down here and they have what they call a bubble ranking. Even as risk metrics rise with interest rates still low, lending standards generally higher than in the past, they're considerably higher than in the past if they're comparing it to the 2008 crash, and macro prudential policies in place, the trigger for a crash isn't obvious, according to the analyst. Shaw said the period ahead will be more likely be characterized by cooling rather than collapsing. Okay, so they used the word bubble in their headlines. everybody's in a bubble, but then he said it was probably just going to be a bit of a cooling instead of collapsing. Well, it's not a bubble. We're going to cool down eventually. Things always return to the means. And hey, Rick, did you see the micro estates they're building in Tempe? Saw an article early today. I have not seen that yet. We've got some chat going on here. Carlos says our home increased by price 38% year over year. That's Queen Creek, I believe, if my memory serves me correctly. No, I'm gonna have to get down there and take a look at those micro housing. That's gonna be interesting. They're micro estates. Send me the address for that. So the headlines you see, and you see it in YouTube too, is crash and then bubble. But then there's always devil in the details. When you get done and you start reading these, right at the end of this article, the guy goes, "Well, it's probably just going to be a bit of a slowdown." Well, then why did you write bubble concerns at the top of that article? That just kills me. So I try to read every crash article I can see. Websites that concentrate on bubbles, YouTubers that are talking about crashes, and I really try to see if I'm missing anything, if they're pulling up a number that I'm not seeing. And then I try to look at our data and find out where our inventory is headed, how fast it's going up, how fast our contracts are going down, how big of a difference it is. And even though it looks big on the graph, it's 400 homes. That's all. All the homes that we have here, the difference between listings coming on and contracts coming on is only 400 homes. So that takes a while. At that rate, I kind of did some math and figured that maybe by November, December, we'll be approaching a normal inventory level of about 18 to 20,000 homes. Maybe. I mean, it only takes 1 or 2 months for that to level out to kind of erase that simple math. But there is a mathematical possibility that we could start ending the bidding wars sooner rather than later. But there's still the mathematical possibility that homes are going to continue to go up in price this year and next year. So we just have to keep a watch out for it. Now, the banks are telling you they're just flush with cash. Some of the banks think that the inflation is temporary and they need more. All the banks are flush with cash, yet they're kind of tightening up their lending standards a little bit. Hoping to ask Pat about that on Friday. I'm hearing things are getting tighter. I also read a headline that said something about Fannie Mae, which said, it was either Fannie Mae or Freddie Mac that said that they wanted investors to limit and banks to limit their second homes to 7% of their portfolio. I think they popped that down to 3% now. So I want to talk to Pat about that on Friday as well. So there's some interesting stuff. We knew it would be an active week when the Fed was meeting this week, and you'll see more headlines coming out of that again. It really was kind of an uneventful meeting. I mean, they didn't announce anything that said that they were going to start pulling back on their tapering on their bond purchases. They're still buying $40 billion worth of mortgage-backed securities every month, and that's a bunch. So I will see everybody tomorrow at 8:30 in the morning. Have a terrific midweek day. Take care.